They say the market has no mercy. But Jesse Livermore knew mercy was never the goal. Survival was. In a world where every tick of the tape whispered temptation, Livermore stood apart, a man whose fortune was made and lost more than once, yet whose mind remains a lighthouse for traders navigating chaos. Voiceover begins, every trader, whether they admit it or not, plays a game of survival. Some call it risk management, others call it discipline. But for Livermore, it was something deeper, a spiritual contract between a man and his capital. He once said, "The game taught me the game, and it didn't spare the rod while teaching." That single sentence, hidden in his reflections, carries the weight of decades spent watching numbers breathe like living things. Livermore understood that markets don't destroy traders. Traders destroy themselves through impatience, through ego, through the quiet erosion of discipline. This story isn't just about his 12 rules of risk management. It's about the mind that forged them. The man who tested each one with his own blood, fortune, and time. Narrative flow. In 1907, he made millions. In 1929, he made history. But behind every fortune lay a set of invisible guardrails, rules born not from success, but from catastrophe. Because Livermore knew, you don't build wisdom from winning. You build it from surviving. He believed money was only the shadow of understanding. That managing risk wasn't about protecting your capital, it was about protecting your mind. And that's where we begin. The 12 Laws of Survival according to Jesse Livermore, a man who outthought the crowd and paid the price for thinking differently. Cinematic cue. Pause for reflection. Imagine yourself in his shoes, standing in a smoke-filled bucket shop at the turn of the century, ticker tape rolling, the crowd roaring. Every trader thinks they've found the secret. Every one of them believes they'll beat the market. And yet, Livermore stands still, silent, watching. He's not chasing the tape, he's listening to it. Because risk, to him, isn't a number, it's a language. And every loss, every margin call, every blown account, it speaks a dialect only those who survive long enough can truly understand. Comment hook. If you had to write your own first rule of risk management, what would it be? Comment it below. There's a strange paradox that lives at the heart of trading. The moment you believe you've mastered it, it finds a new way to humble you. Jesse Livermore knew this intimately. To him, the market wasn't just numbers and charts. It was a mirror reflecting the trader's own strengths, weaknesses, fears, and ambitions. He once observed that the human side of every person is the greatest enemy of the average investor or speculator. Think about that for a moment. The human side, not the market, not the economy, not the algorithms, but us. The part of us that hungers for certainty in a place built on uncertainty. It's the paradox that defines every market participant. We crave control in an environment designed to punish control freaks. We seek patterns in chaos, believing that understanding it gives us power, when in reality, it's the humility to not know that keeps us alive. Story flow. When Livermore began trading, he was barely a teenager. A quote boy in bucket shops, watching customers place reckless baits on price movements they didn't understand. He didn't just see the trades, he saw the emotion behind them. The trembling hands of greed, the frozen faces of loss. It fascinated him, because what he noticed early was this. Most traders didn't lose because they were wrong about direction. They lost because they were wrong about themselves. They believed they could control outcomes. They couldn't. They believed the market owed them a win. It didn't. They believed their system would save them. It never did. Livermore's paradox was this. To win, you had to surrender. To survive, you had to stop fighting the market and start understanding your own nature. Emotional deepening. There's a quiet terror in realizing that the market is not your opponent. It's your reflection. When you feel panic, it mirrors it. When you grow euphoric, it tempts you. When you grow complacent, it punishes you. This was Livermore's great psychological battle and the foundation for his risk management philosophy. Because risk, as he defined it, wasn't measured in dollars or percentages. It was measured in how much emotional exposure you allowed yourself. He'd say, "The desire for constant action regardless of underlying conditions is responsible for many losses in Wall Street." That's not just a warning, it's a mirror held up to the restless mind of every modern trader, endlessly clicking, refreshing, checking, chasing. Cinematic pacing. The paradox of the market is that it rewards patience, yet seduces urgency. It punishes emotion, yet demands conviction. It gives clarity, only after it's too late. Livermore learned that the greatest conflict wasn't between man and market. It was between man and himself. The battle between discipline and impulse. Between the plan and the moment. And that's where his first lessons in risk management were born, not from strategy, but from suffering. If there's one truth Jesse Livermore spent a lifetime proving, it's this: traders rarely lose because of lack of information. They lose because they can't handle what they already know. Every trader, at some point, falls into a quiet, deadly trap, the illusion of control. It begins innocently. A few winning trades, a growing sense of mastery, a whisper that says, "You've figured it out?" But as Livermore would later confess, that whisper is the most dangerous sound in the world of speculation. Because in that moment, you stop managing risk. You start managing ego. Story flow. Livermore described the market as a great leveler. It strips away the unworthy, the undisciplined, the overconfident, not out of cruelty, but out of nature. To him, risk wasn't just a concept, it was a living presence, the invisible boundary between rational action and self-destruction. He noticed something profound. Most traders don't blow up because of a single bad trade. They blow up because of what happens after a winning streak. When profits come easily, discipline weakens. When a trader feels invincible, rules turn into suggestions. And soon, the line between calculated risk and reckless exposure disappears entirely. This is the psychological trap, the same one that has claimed fortunes for over a century. It's not the bear market that ruins you. It's overconfidence in the bull. Psychological deep dive. Livermore once said, "After a man makes money in the stock market, he feels he knows the game. He doesn't. He's lucky, and he doesn't know it." That quote slices right through the modern trading world, where algorithms promise certainty, indicators promise safety, and influencers sell no-risk systems. But risk can't be eliminated. It can only be respected. Livermore's trap wasn't external. It was internal. The temptation to believe that his intellect could outsmart the tape, that his experience made him immune to the market's wrath. Even he, the man who called the 1929 crash, would fall victim to it again later in life. Because no matter how great a trader becomes, the mind never stops whispering, "You've got it this time." Cinematic reflection. The most haunting part of Livermore's story is that he understood his own weakness, yet still couldn't always escape it. That's the paradox of human nature and markets. You can know the right thing to do and still fail to do it. It's not a lack of knowledge. It's the presence of emotion. And emotion, left unchecked, becomes the trader's silent assassin. So, when Livermore built his 12 risk management rules, he wasn't writing guidelines for the market. He was writing restraints for his own mind. Each rule, a wall between himself and his worst impulses. Each one, a reminder that survival was never about brilliance, it was about control. Livermore's philosophy was simple but profound. Know yourself before you know the market. Because only when you understand your own thresholds can you define what risk really means to you. The ticker tape never slept. In the fall of 1929, as the market roared higher with unstoppable optimism, brokers were buying yachts, newspapers were predicting endless prosperity, and taxi drivers were giving stock tips. It was the age of illusion, the moment before the fall. Livermore had seen this movie before. He'd watched the same pattern unfold in 1907 and even earlier in bucket shops when greed would swell like a tide, pulling logic under its weight. This time, though, the stakes were global. He could feel it, the tension, the mania, the blindness. Prices were disconnected from value, and the crowd was dancing on a floor about to collapse. And yet, in that noise, Livermore was silent, observing. waiting. He knew the most dangerous words in speculation. This time it's different. The setup. While the public bought every dip, Livermore began quietly building short positions, methodically, patiently. He didn't fight the market, he followed the signals of exhaustion, volume spikes, irregular patterns, a sense that emotion, not logic, was now in control. His brokers thought he was mad. Friends told him he'd lost touch. But Livermore wasn't betting on panic, he was betting on human nature, because he knew, when everyone is on one side of the boat, it only takes one wave to tip it over. Then came October 24th, Black Thursday. The tape slowed. Prices began to tumble. Margin calls erupted like gunfire. And in that storm, as fear consumed Wall Street, Livermore did what he always did best, nothing. He simply watched, calm, detached, waiting for confirmation that the trend had turned from hope to despair. Then he pressed. And as the crash deepened, Livermore's fortune grew, not from luck, but from discipline. By the time the dust settled, he had earned more than $100 million in $1,929, a staggering fortune. Newspapers hailed him as the man who broke the market. But Livermore saw it differently. He hadn't broken the market. He'd survived it. Philosophical reflection, that moment wasn't triumph, it was validation. His risk rules had protected him where greed had destroyed others. He didn't chase rallies. He didn't average down. He respected risk when others mocked it. And that, to Livermore, was the ultimate lesson. The goal isn't to predict the market's next move, it's to be positioned safely enough to survive whatever it does. It's ironic. The very discipline that made him rich also kept him humble, at least for a time. He knew his gains were not proof of mastery, they were proof of survival. Cinematic reflection, picture that moment. Manhattan in ruins, traders broken, fortunes gone. And one man, alone in his office, quietly writing notes in his trading journal, not celebrating, studying, because he knew that every victory in the market carried the seed of the next downfall.
Success has a sound. It's the rustle of ticker tape, the hum of a crowded exchange, the thrill of being right when the world is wrong. But when the noise fades, when the trades are over and the fortune is counted, what's left? For Jesse Livermore, that silence was unbearable. After the crash of 1929, he was hailed as a genius, the boy plunger turned great bear of Wall Street. He had wealth beyond imagination, more money than the US Treasury held in surplus at the time. But here's the tragedy, the more he gained externally, the more he lost internally, because the market had always been his mirror. And when he looked into it now, he no longer saw a challenge. He saw emptiness, psychological descent. This was the cruel paradox that Livermore's life exposed, the very qualities that made him a great trader. Obsession, solitude, control were the same forces that consumed him outside the market. He built his empire alone. He studied in silence. He trusted no one's opinion but his own. It was perfect for trading, but devastating for living. As the 1930s unfolded, volatility returned, but not in the markets. In Livermore's mind, his rules still worked, but his discipline wavered. He began to take larger positions, sometimes ignoring his own safeguards. He broke his sacred commandment, never add to a losing trade, and slowly, the market began to take back what it had once given. By 1934, the same man who had once been worth hundreds of millions was now facing ruin again. His accounts were over-leveraged, his judgment clouded, his confidence fractured. Livermore had always said, the market is never wrong, opinions often are. Now he found himself trapped in the truth of his own words, realizing too late that he'd stopped following his system and started following his emotion. Emotional low point. There's something haunting about that realization, that knowledge alone isn't enough to save you. He knew every principle of risk, every law of probability, every lesson he'd ever taught others. But when his emotions took over, none of it mattered. That's what makes Livermore's story timeless. Because every trader knows that feeling, when you break your rules, hoping for redemption instead of discipline. When you tell yourself, just this once, that's when the market pounces. Cinematic moment, pause in the end. Jesse Livermore wasn't destroyed by a bear market or bad luck. He was destroyed by the one force he couldn't control, himself. And yet, within that collapse lay his greatest gift to us. The understanding that risk management is not about money, it's about mental preservation. Because even at his lowest, he wrote meticulously, obsessively, about what went wrong. Those notes, that reflection, became the backbone of his 12 rules. Rules meant to protect future traders from the same psychological destruction he endured.
To understand Jesse Livermore's approach to risk, you have to understand the man behind the trades, a thinker shaped by volatility, not comfort. While others chased the market, Livermore listened to it. While most traders sought to predict, he sought to observe. He saw risk as a living organism, unpredictable, shifting, and deeply personal. To him, every trade wasn't about profit. It was a test of judgment, discipline, and self-restraint. Livermore once said, "There is only one side of the market, and it is not the bull side or the bear side, but the right side." But what he didn't always say aloud was what he meant by the right side. It wasn't direction. It was alignment between your method, your psychology, and your tolerance for loss. Because to Livermore, risk wasn't something to eliminate. It was something to balance. Psychological reflection in his mind, every trader was like a pilot flying through turbulence. You can't stop the storm. You can only control your altitude. The market would always shake you. The question was, how much could you withstand before losing control? Livermore viewed this balance as sacred. When he won, he didn't celebrate. When he lost, he didn't despair. Instead, he examined the why. Was it because the market changed, or because he did? This was his unique insight. Risk management isn't about reacting to the market. It's about managing the internal variables, fear, hope, and ego that distort your perception of it. He learned early that a trader's biggest mistake was to believe that past success equaled future control. That's why he set strict personal rules. Never risk more than a certain portion of capital on any trade. Never add to a losing position. Always cut losses fast. To others, these seemed mechanical. But to Livermore, they were spiritual, commandments that kept emotion from rewriting the truth. Historical context and tone shift. By the time Livermore had become a legend, after the Panic of 1907 and again after 1929, reporters wrote of him as the Great Bear of Wall Street. But behind the headlines was a man constantly at war with himself. He knew that wealth was fleeting and risk eternal. He once said, "There is nothing new in Wall Street. Whatever happens in the stock market today has happened before and will happen again." That was not cynicism, it was wisdom. Because if human nature never changes, then risk is not external, it's psychological. Cinematic reflection. Imagine standing where Livermore stood, in his trading room, with tickers printing endlessly, prices moving with violent rhythm. He wasn't watching for signals, he was watching for behavior. The markets and his own. That's what separated him. Where others saw chaos, he saw pattern. Where others saw randomness, he saw human emotion repeating itself in cycles of greed and fear.